Good evening, sir.
Okay, so you're welcome again to another class on financial reporting. So last week, we finished up with IAS 16 on property, plant, and equipment. And I want to believe that you have gone through that class and you have revised all I've taught you, especially those practice questions we have solved. I want to believe that you have gone through everything. If you have, then you are welcome to IAS 38 on intangible assets. Now, what do we want to look at in IAS 38? We're going to look at the accounting treatment for intangible assets. Then we're going to look at the criteria for recognition of intangible assets. We'll look at how to determine carrying amount. And also, we will look at disclosures about intangible assets. So the first thing we need to identify and understand is for us to know what is an intangible asset. And for us to do that, we need to look at the definition given by IAS 38 for an intangible asset. And IAS 38 said that an intangible asset is defined as an identifiable non-monetary asset without physical substance. This definition has three key terms. The first term is identifiable. The second is non-monetary assets. And the third is without physical substance. As soon as we're able to identify those three, then we would understand what an intangible asset is. So the first one, which is identifiable. For an intangible asset to be identifiable, it means that, one, that asset must be separable or must arise from legal or contractual rights. So it's either of the two. That's what we mean by identifiability. It is separable or arise from legal or contractual rights. Then what do we mean by separable? So separable means that we should be able to either sell or transfer or rent out that intangible asset separately. We should be able to sell it or acquire it. And it should be separate from the entity in itself. So the assets should be able to be separated from the entity as a whole. Should be able to sell, transfer, or rent it out without it affecting the entity as a whole. An example of that is a license. License. For example, now, most banks usually get licensed before they can run commercial banks or either microfinance bank or mortgage bank. They are usually licensed by the Central Bank of Nigeria. And those licenses, if whoever has gotten the license is tired of running banking business, he can sell the license. He can transfer it to another party. The license is an intangible asset because it's separable. Another type of intangible asset that, as a result of being separable, is that is a patent. A patent. And when we say patent, we are talking about when you invent an item or you invent anything or you create something or your invention, you can meet, there's a body in Nigeria that you pay to, they will patent that your invention in such a way that no other person can claim ownership of that invention except you. In fact, no other person can copy what you have done. body. So that's patent. That patent, when it is an intangible asset. And if you wish, you can sell it to another party. Another one is brand name. Brand name also is an intangible asset that you can sell. So like Net Worth Professional Academy, for example, now, most people know us because we have developed a brand. Like Google, for example, now, most people know them because they have developed a brand. So we can sell our brand, right? If, for example, now, let's say you're in Kano and you want to start a tuition center. So if you don't want to go through the hassle of getting your name known, you want an established name, we can give you our name. Okay, use Net Worth as the name of your center in Kano. You just pay us certain money. So what we have done is we have sold our, it didn't affect us. We will still be doing our business. So that's what we mean by something being separable. So licenses are separable. A patent is separable. Even brand names is separable. That's one part of identifiability. The second part is that it must arise from legal or contractual rights. That's the alternative. It's either of the two. It doesn't have to be the two to be identifiable. If an asset is separable, it is identifiable. If it is arising from legal or contractual rights, it is identifiable. And when we say legal or contractual rights, we are talking about, for example, we have customer contracts, or we have entered into a deal with let's say the government. They are giving us huge contract. Let's say they gave us a contract that we should connect the whole of Nigeria through rail. A contract that is worth almost $2 billion. Like the Ministry of which ministry again? I can't remember. That wants to connect the whole of Nigeria through fiber optic, so that we'll have easy access to internet. So let's say they now give our company that kind of contract, and they said it's going to cost them around $1 billion. They give our company that kind of contract. So one thing happen whatsoever, let's say another company now acquire us. They acquire my company. And don't forget, we just got a big contract. The company that just acquired us, if he sees that contract in his books, he will recognize that as an intangible asset. It's an asset because it's something that will make money for him. Okay? So a customer contract can be an asset, not because you can sell it separately. You cannot, it's not something you want to sell separately, but it's something that arise from contractual or legal rights. Is arising from contractual or legal rights. Another one that can arise from contractual or legal rights is a franchise. Franchise. Like most of these KFCs that you see around, for example, now you see KFC everywhere. The main KFC body is, I think, I think is in US, the major KFC body. All these other ones that you have seen, what they have probably done is that they have bought a franchise from KFC for them to be able to use that name. For them to use that name, KFC, and put it on top of their shop that, okay, yes, we are. So me, if I have bought a franchise from KFC, I'll give KFC so much money, then I can use their name. That money I paid for me to be able to use their name is a franchise. And I must have entered into an agreement with KFC that I cannot go and give another company that, okay, you should use KFC. No, I don't have that. So for me, even though that franchise that I've gotten from KFC is not separable, right? but it is an intangible asset in my books because it's arising from legal or contractual rights from the agreement I have with KFC. It's just like, let's say our school now, Network. We decided to change our name to Harvard. Harvard. We now went to meet Harvard that we want to use the name Harvard. And they said, okay, no problem, pay $1 million. Okay, we'll raise the $1 million, then we'll pay them. What we have done is that we have bought a franchise. So in all our centers, Harvard. So of course, it's going to have, it will add prestige to our institution, and a lot of people will want to come to Harvard, right? So that's a franchise. In my books, when I'm preparing my books, that $1 million I've paid to Harvard, I'll just put it as an intangible asset franchise. So me, I cannot now go and sell it to another school. That means I want to sell this Harvard. No, it's not separable. It is not, it's not separable, but it's an intangible asset in my books because it is arising from contractual or legal right. Okay, so that's the first part of this definition, identifiable. Identifiable is either it is separable or it is arising from legal or contractual rights. And I'm giving you examples of this type of asset. The second one is non-monetary assets. You see, and for an item to be an intangible asset, it must be a non-monetary asset. And for you to understand non-monetary, let's understand what monetary is first. You see, when you have bank or you have investments, long-term investments, where a fixed amount will be received, meaning that you know how much you are going to collect from that item. But when you have trade receivables or loan receivables, you know how much you're expecting from the money you have in your bank. You know how much you are going to get if you go to your bank today. From, let's say you bought shares, you have an investment. If you sell today, you know how much you're expecting. If you have trade receivables in your book, you know how much. Those are monetary assets where you would receive a fixed sum. An intangible asset must be non-monetary in the sense that the amount you would get should vary. It should be variable. It should depend on how well you use that item. It should depend on how well you're able to convert it to benefit. That's a more monetary asset. So an intangible asset must be a non-monetary asset. And finally is that it must be without physical substance, meaning that it's not something you can see, it's not something you can touch. That makes it an intangible because it's without physical substance. Okay, that's the definition for an intangible asset. And looking at this definition is not so straightforward, and I don't know the need for this complexity. But if you are asked in the exam to explain what an intangible asset is, you must be able to tell the examiner that it is an identifiable non-monetary asset without physical substance. But the thing is this, what really distinguishes this definition from PPE that we have learned is this without physical substance. Because if you look at it critically, PPE that we learned last week and the upper week is identifiable. You can sell your motor vehicle. You can rent your motor vehicle. You can transfer it, right? And there are some PPE that will arise from contracts, right? Maybe you enter into a contract with somebody that they should give you a motor vehicle that you want to use it for your production. So most PPE are identifiable. And in fact, they are non-monetary also. They are non-monetary because the money you will get from your PPE depends on the quantity you produce and how well you use or utilize that your PPE. So this definition is not like is so peculiar to intangible asset, but they have chosen to define intangible assets in that regard. So you have to know it like that for now, since that's what the standard wants. So an intangible asset is an identifiable non-monetary asset without physical substance. Okay, so this example is just giving you an example where a guy, Entertain Co. wanted to buy a brand from Gadget Co. 1.2 million. So the story is that, okay, the Entertain just recognized the brand in his books as an intangible asset, the 1.2 million. You should recognize it in his books as an intangible asset. So you can look at it, but that's the whole point there. Now, we have looked at definition. Now, let's look at how do you recognize an intangible asset in your books? If you remember, the way we recognize PPE is that, as we said, it must be probable that future economic benefits associated with the assets must flow to the entity. And two is that it must have a cost that can be measured reliably. The thing is that it's the same for intangible assets too. The same thing. The same recognition criteria. If you look at it, an intangible asset can only be recognized if it is probable that the expected future economic benefit that are attributable to the asset will flow to the entity, and the cost can be measured reliably. The same thing as PPE. Then for measurement, so for intangible asset now, the way we buy an intangible asset or originate an intangible asset is different. There are some intangible assets that are purchased, like license, for example. Now you pay for license, like like a franchise, for example. Now you pay for that, like a patent, you pay for that, like trademark, you pay for that. Those we call purchased intangible assets. Why there are some that you don't buy? Those ones you are the one that develop them yourself, like your brand name, like your goodwill, like your trade secrets, like maybe customer lists, like maybe you have a software that you built yourself. Maybe you have, there's something they call masthead for all these newspapers that are so popular. Those are not purchased. They are internally generated. They call that internally generated. Okay, so why am I talking about that? Is because the way we measure them are different. So the first one, which is a purchased intangible asset, the initial measurement is that they are initially measured at cost. They are initially measured at cost, which is the amount you have paid for it. Everything I taught you under PP, as far as measurement, both initial measurement and subsequent measurement is concerned, is the same thing, the same for purchase intangible assets. It's the same thing. So that cost that I taught you under IAS 16, that I told you that cost comprises purchase price plus import duties plus non-refundable purchase taxes plus trade discounts and rebates. All of that applies here. Remember, then we also mentioned directly attributable cost of bringing the asset to its location and condition ready for use. All those are applicable here too. So it's the same for initial measurement of PPE. It's the same as the initial measurement for purchased intangible assets. However, for internally generated intangible assets, like brand name, like goodwill, like customer lists, like, which one did I mention again? Yeah, those other ones that you are the one that develop them yourself over time. This IAS 38 says that those ones are not recognized in the books. They are not recognized in the books. And the reason is that we cannot determine their costs or the benefit attributable to them reliably. For example, now, you have a goodwill that you have developed over time. That one now, how do we determine how much? We want to put it in our books. How much? How much did we buy it? It's not something we bought, it's something we have developed over time. So we cannot say this is the price. Another one is how do we know the amount of benefits we are getting from it? All these things are difficult. So for that reason, they said that when you have internally generated assets, don't even put it in. So it should not be recognized in the financial reading. Another one is research and development. And this research and development is also internally generated, right? This research and development is speaking to like a software, for example, now, a software that you developed ground up yourself, right? The reason why they are separating research and development from other internally generated intangible assets is because for research and development, you know how much you have spent on that. And that really has to do with the projects that you work on, like a software or any other technological-based project that does not have physical substance, okay, that you can know how much you have spent. So that is internally generated, but for that we can trace how much you have spent, call it research and development. And that is what they will also call it in your exam too, research and development. So there are two costs here. They are not the same. There is research cost and there is development cost. So for research cost should be expensed. It should be transferred to P or L. It's not something you capitalize as an asset. Expense it. But development costs, that can only be capitalized if it meets 6 criteria. 6 criteria. I can usually ask this a lot. And these 6 criteria, so that you can easily memorize it, I would put it as I codified it as pirate for you. P-I-R-A-T, it's pirate, which are the 6 criteria that must be met before a development cost can be recognized or can be capitalized as an intangible asset. If it doesn't meet these 6 criteria, then that means you have to expense it. That means you would expense it. And what are these 6 criteria? Number 1 is that it must be probable that there will be economic benefits. That's the P. Number 2, there must be intention to complete the project. And the R is that resources are available to complete the project. Number 4 is ability to use or sell the item. Number 5, it is technologically feasible to complete it. And finally is that expenses on the project can be identified. You have to know these 6 criteria. That's why I codified it as pirate, so that you use that to remember it. However, in your exam, the way you will know that an intangible asset or a development cost has met the 6 criteria is usually when the company has gotten like a regulatory approval or a government approval. Usually it's that from that date that it will have met these 6 criteria. When they give you like additional information in your question 1, it's usually when it has met these 6 criteria that you can say, okay, then it must have met this recognition or measurement criteria. So that's for development cost or research and development costs. So finally, so what I just want to point out here is this, is when they teach you group account, consolidated financial statement, you will see that IFRS 3 allows the parent, when he's preparing his consolidated financial statement, to include almost all internally generated assets in their consolidated statement of financial position, like brand name, for example, now. Brand name, or even research costs that were expensed, or even goodwill. You can put it in a consolidated account, even though in the individual financial statement of those entities, we said, because we cannot determine their costs and their benefits, that we don't capitalize them, that what we do to them is expense them. But when they teach you group account, you'll find out that most of these items are capitalized. They put them as an intangible asset in a group account. The explanation is that that's because on consolidation, the parent actually paid for it, right? When he wanted to acquire the subsidiary. So he knows how much it's worth. So, and that's why. Sorry? Okay. So let's look at this example. So this looks at a company called Resco. They said they are developing a new line of pharmaceuticals, and they have spent 2 million up to 1st January 2005. They now said on 1st January 2005, the board gave approval to fund the rest of the project, following promising results, and they spent a further 1 million to 1st April 2005. They now said on 1st April 2005, problems were discovered in the trials, and approval was not given from the medical regulator for use of the pharmaceuticals. Okay. And I said, Resco spent a further 1 million to 1st of July 2005, at which point approval was given. So they got approval on 1st July 2005. Now said, from 1st July 2005 to 1st October 2005, Resco spent 1.5 million putting the product into the final finish stage of development. The new pharmaceuticals are expected to generate revenue in excess of 20 million and have a useful life of 5 years. So they can give you this kind of question and tell you that how much should we capitalize. Look at the solution here. He said in the financial statement of Resco, only 1.5 million of expenditure could be capitalized, as it is only from 1st of July 2005 that all of the development criteria are met. And like I told you now, that in exam, the way you would know when they have met all of these criteria is when they have gotten regulatory approval. And if you look at it, all the money they have spent, the 2 million they spent, the 1 million they spent here, and I think they spent a further 1 million again, all of them will be expensed. You see, is the dates they got approval from July 2005 is money they spent after that time that will be capitalized. Any other money will be expensed. Any other money will be expensed. Okay. Do you have any question up to this point? Okay. So now let's look at subsequent measurements. So So similar to IAS 16, intangible assets are subsequently measured either at cost model or evaluation model. Either at cost model or evaluation model. And for the cost model, is the same thing under IAS 16, the same thing. Cost model is just cost minus accumulated amortization minus accumulated impairment losses. The difference is that one that we call depreciation in IAS 16, here, call it amortization. That's just the difference. That's just the difference. For evaluation model, we said usually evaluation model for the year is fair value or revalued amount minus subsequent accumulated amortization minus subsequent accumulated impairment losses. The difference here is, again, is that here we are using amortization instead of depreciation. That's just the difference. And finally, is that one thing you need to note for this subsequent measurement is that usually when you have usually you will find yourself having most intangible assets having an indefinite useful life. When an intangible asset have an indefinite useful, you do not amortize it. You don't amortize it. What you do then is that you are going to test them for impairments annually. You are going to test them for impairments annually. That's what you do for an intangible asset with an indefinite useful life. That is also similar to PPE. Remember, I told you that when an item of PPE has an unlimited useful life, you don't depreciate it. And that is why we don't depreciate land. Okay, so it's similar here too. When you have an intangible asset with an indefinite useful life, we do not amortize it. The only thing we do is just to test it for annual impairment. And in addition to that, is that when an intangible asset, when it has indefinite useful life, in addition to testing it for impairment annually, we must also reassess that useful life every, whether it is definite. Because when you're talking about intangible assets, in a real sense of it, they are majorly technological-based assets. Technological-based assets. So, like a website, for example, now, website, you incurred money to develop a website. It's an asset to you, and it is intangible. But what is the useful life? It can be indefinite. So you need to be reassessing it every year. That is this useful life still indefinite? Because the thing about technology is that a new technology can render the end of what you call an intangible asset, that you'll have to develop it over again. Okay, so that's why at the end of every year, we reassess it. Is this still indefinite? Is this still indefinite like that? Another thing you need to know, especially for evaluation model, is that for intangible assets, before you can use evaluation model, the asset must have an active market value. It must have an active market value, meaning we must be able to know their market value. Okay? If it's not an asset that we can know its market value, then you cannot use a revaluation model. For example, now you got a license from the government. So you cannot use revaluation model for that. Or you got a patent or trademark or copyright. You cannot use revaluation model because why is the market value? There is no way you can know. So there must be somewhere, there must be an active market that you can get pricing information for you to be able to know what is the selling price of this item. Otherwise, don't even go to revaluation model at all. So in the exam, one thing I think you need to know and remember is that for intangible assets, know that you can only use evaluation model where there is an active market for that asset, where you can get fair value or pricing information. And that is it about subsequent measurement. And really, that is it about intangible assets. That's everything about intangible assets. So the final thing is just disclosures, which is also the same thing as PPE. The same disclosure is the same disclosure requirement here too, except I just added some things to state whether the useful life is finite or indefinite. If it is finite, what is the useful life? It is indefinite. Why the usage is indefinite, and give us explanation around your research and development that are written off as expense. Okay, so that's it for intangible asset. Now let's questions. Okay, so I saw your hand, Chinedu, so I just wanted to finish my explanation so that it will flow before I attend to you. So you can ask your questions now.
Okay, my question is on I wanted to ask on the approval. You know, the pharmaceutical center that I use, like a government, what if it's a private company? Maybe they have like a software that is being developed internally. At what point do we know that the software should be capitalized? Is it
Okay,
when the
so
board approved it, or is there any other thing that you consider?
yeah, fantastic question. So in the exam, they will tell you, they will tell you, they will tell you that okay, on this date, so the company is sure that they can complete the project, or the company is now sure that this project is technologically feasible, like that. In the exam, they will tell you, you will see, you will solve one or two of them. So you will know. But in practice now, it's now left to you to know at what point have you started development, especially like you mentioned, so you're developing a software that does not even require regulatory approval, that is just internally. So, and it's not any board approval, because really, before you even commence research, board must approve, right? Board must approve that, please go ahead. So in reality, it is left to the judgment of the entity to know where does research stop and when are we starting development. For most companies, it's going to be as every money they are spending from day one they started development of the app, where the team started working on the system exactly. So what they'll probably expense would be maybe um, the bots development environment, maybe they had to recruit, the recruitment expenses, maybe they had to rent somewhere as office space, those ones will be expensed. But when they started development, that those guys started writing their codes, from that date, I'm sure they will start developing or capitalizing any other course incurred. That's what will have happened in practice. Okay, but you will see as you move on. Now let's look at this question. This is a past question, 2018. So this question states that intangible assets by their nature do not exist physically under IAS 38 intangible asset. The following information on initial cost of intangible assets were extracted from the notes to the financial statement of Igbowood Limited, a film production company, on January 1st, 2017. So they gave us all of these items. So they now give us some additional information on these items. They give us the dates they acquired them and their useful life. That's additional information one. Additional information two, they said the intangible assets should be amortized on a straight line basis. We are now asked to calculate the costs of the following intangible assets: market-based, customer-related, artistic-related, contract-based, technology-based. Two, calculate the carrying amount of the following intangible assets as at December 2017. Then three, identify four internally generated intangible assets that are prohibited in IAS 38. Okay, so I can remember vividly, just like yesterday, this 2018, when they asked this question, we complained so much because IAS 38 didn't classify intangible assets in this manner, market-based, customer-related, artistic, whatever. So even when we're providing the solution that it's we could not even agree that which of these ones should be market-based, because so what we did, all students that attempted it, irrespective of where you put any of this, they got all their marks. So the ones that did not get any mark are the ones that said, I've not seen this one before, I don't know it, oh. They just move to another one, or they just ignore the question and did not attempt. But the ones that attempted and put any item under this classification, they got their full mark. Okay, so let's look at it together. So these are the items, these are the intangible assets. They want us to get their cost and based on this criteria. So the first one, which is books and literary works, 800,000. That is more like artistic. That is more like artistic related. You can put down that artistic is related. I've already done the solution and I've sent these notes to you. So everything is there. So these books and literary works is artistic, I think. So if there's anyone you disagree, just let me know. So there's QuickBooks and Sage. This is more of technology. So I'll put it under technology. There's patents. For patents, before you can get a patent, you must have invented something. So I'll put that as technology. There's video and motion films. I'll put that as art, artistic. There is franchise. Okay, that will be, I'll put that as contracts. It's contract based. There is pictures and photographs, artistic. Order or production backlog, I'll put that as customer related. Customer related. And there's place, artistic. Then there's customer contract. I can either put it as customer related or put it as contract based. It to go to for either of the two is okay. Then what about trademark? Trademark. So what's trademark? Where can it be? Trademark.
Can it be market based?
Why do you want to put it as market based?
It's a trademark. It's customers that bringing royalty to the company. It's what you are known for.
Okay, yeah. So I think I agree with that. Let's put that as market based. Let's put it as market based. Broadcasting rights. Let's put it as contracts. Internet. Where should internet be? If I want to follow the explanation you gave for trademark, can we put internet too as markets?
Should be technology, sir.
I agree with that as well.
It should be technology. But is it not your internet or your website they will use to know you?
Technology brought about internet.
Okay, all right. I think I agree with you. So let's put it in technology. What about trade secrets? Trade secrets. Like if you have like a secret recipe that there's nobody that knows except you, that's your trade secret. Something that you are using.
Market based.
Market based. Market trade secret. Is that not technology?
Yeah, sure.
It cannot be technology. A trade secrets. It's not an invention. Okay, if you put it as market-based too, it's not wrong. So, but me, I will just put it in technology. So you will find a solution here anyways. But everybody got their full mark that diet because it's usually subjective for the most part of it. For the most part of it is subjective. Okay. Then they asked us to calculate the carrying amount of the following intangible assets: QuickBooks, trademark, place, and franchise. Okay, straightforward. When they say carrying amount is simply cost minus, in this case, accumulated amortization. That's carrying amount. So they want us to calculate carrying amount. For QuickBooks, for example, now, I will just look at how much is the cost of the QuickBooks? 950,000. That's the cost. I determine my accumulated amortization. I'll look at what's the useful life, 5 years. When did I buy it? 2016. When am I determining this carrying amount? 2017. Good. So that means I bought it like 2 years ago. If I bought it in 2016 and I'm doing my account in 2017, that means 2016, 2017. So I bought it 2 years ago. So if I want to get my accumulated depreciation, I will just do 950 divided by 5. That would give my amortization per annum. I will just multiply it by 2 years. And that's what I did here. So I got the cost, 950. The accumulated amortization, 950 divided by 5 multiplied by 2. That gives me 380. My carrying amount is now 950 minus 380, and that's 570. The same thing for the trademark. The cost in the question is 46. The accumulated amortization is that 46 divided by 8 years, which is the useful life, multiplied by 3 years. Why 3 years? That's because this trademark was acquired January 1st, 2015. That's 3 years ago. Because this is 2017, so 15, 16, 17. So I just multiply by 3. And that's what I did for plays also. 42 divided by 7 years, multiplied by 4 years. 4 years is like we bought it 4 years ago. Same thing for franchise too. 3 divided by 8 by 5 years. Just to get my carrying amount. So that's quite straightforward. Then the last one says that you should identify 4 internally generated intangible assets that are prohibited in IAS 38. Don't dub your note. Can each of you give me one? Give me one. I'm waiting. Yeah, now. Chinedu,
Trademark.
Kayode, Lobet. Brand name, yes, that's correct. Brand name. Any other one?
Their customers, maybe their list or database.
Yes, that's correct. Your customer lists, that's correct. Which one
Right.
again? Sorry? Trade secrets, yes, that's correct. Abiodun said trade secrets. That's also correct. Goodwill,
Copyright.
correct. What's it?
I mean, copyright.
No, that one is not internally generated. You pay for that one. You pay for copyright.
Oh, I see. Internally. Yeah.
I think we have mentioned almost 5. Brand name, trade secrets, goodwill. Chinedu mentioned something. I can't remember.
Customers database on their list.
Yes, our customer lists.
So I say customers database or their or list of customers that you have.
Yeah, that's correct. That's correct. Okay. So that's that for this question. So let's go to another question. This one is also a past question that was asked in 2022 May, and it was for 9 marks. And what the examiner wanted us to do is that we should prepare with comparative figures, statement of financial position. Sorry, just give me. Okay, sorry. So the examiner requires us to prepare with comparative figures, statement of financial position extracts of AZ Nigeria Limited as at June 30, 2020, show relevant notes for PPE and intangible assets, 9 marks. Okay. So they said an extract from non-current assets register of AZ Limited as at July 1st, 2019 were as follows. From these requirements I read, I can see that the year end of the company is June 30th, 2020. And from immediately I can know that this is the beginning of the year. And this examiner made a mistake, this died. This is not a fixed asset register. This is a fixed asset schedule. A fixed asset register is always more detailed than this because that will have the date of acquisition, the amount, the name of maybe the tag, and a lot more details than just this is a schedule. It's a schedule you will do the depreciation and all of that. Okay. Okay, that's what we have. So now they gave us all these figures at the beginning, the costs, the accumulated depreciation or amortization, and also the carrying amount, all at the beginning. And they gave us this additional information. First, the computer software now, we are told that the computer software license was acquired from Microsoft Zap, incorporated in USA on July 1st, 2018, and has 10 years lifespan. Okay, and I said in June 2020, a review of the sales of the computer software showed a very big decline in patronage. As a result of the review, estimated recoverable amount of the license as at the end of the year, which is 2020, was 333 million. The license is amortized on a straight line basis. Okay, so again, since they want me to prepare my statement of financial position at these dates, and they told me that they have reviewed the value of this license, and the value is now 333 million. That is my carrying amount. That is what I need. But since they want us to do notes also, and I've already taught you that anytime they tell you fair value, or they tell you that they have revalued an asset, I told you last week that in order to make a lot of things easy for yourself, the first thing you need to do is for you to determine a revaluation surplus or deficit, which is what I've done here. The fair value given was 333 million. I compared that with my carrying amount. And my carrying amount is cost minus accumulated amortization, because this is software. So it's intangible. So the costs from the question at the beginning is for this software is 1.1 million. Then the accumulated depreciation, they already gave me the accumulated depreciation till the beginning, which is that's why I have brought forward here. All I just need is for the year. So even without anybody telling me, I need to know that they charge equal amount of depreciation every year. So the useful life of this intangible asset they give us here is 10 years. And they said they use straight line basis, which is cost all upon the useful life. And the cost is 1.1 million over 10 years. That gives me 100,000. So if I remove this accumulated depreciation from this cost, I get my carrying amount. If I remove my carrying amount if I compare it to my fair value, that will give me a revaluation deficit of 547,000. But when I'm preparing my statement of financial position, what goes to my books is this value at the end. Because you have given me the value at the end. Is this one that goes to my statement of financial position. So that's the first one. The second one, they said that the freehold property consists of land and building, which were valued few years ago for 395 million attributable to land, 600 million attributable to building. That is 995 for the land and building. 600 plus 395, 995. And that's this 995. So the value at the beginning, they are just bringing it down for us or to us. Okay, into land and building. Then I said on that date, the estimated remaining life was 24 years. Okay, when they revalued it, 24 years. However, a second revaluation of the freehold property was on July 1st, 2019. Then 410 million is land, 560 million is building, and the remaining useful life is 20 years. Okay. So again, this one, they are doing evaluation, and I've told you, anytime you see evaluation, just go and do your evaluation surplus or deficit. And this evaluation is happening at the beginning of the year, this 2019. So freehold property evaluation, the fair value given in the question for both land and building is 970 million. This is it. If you add 410 million, 560 million, gives me 970 million. That's my fair value. I compare that with the carrying amount. Since this is at the beginning, I can easily get the carrying amount for the land I'm building at the beginning, which is this, the freehold property. This is the carrying amount at the beginning, 895 million. They have already done it for me here. So I have my evaluation surplus to be 75,000. So since this is at the beginning, I will need to get my depreciation for the year, which is my fair value over the remaining useful life. We do not depreciate land, so I'm only allowed to depreciate building. And the value of the building at the beginning was 560 million for building. The remaining useful life is 10 years, no, 20 years. So I just did 560 divided by 20, and that gave me 28,000. So my carrying amount, my fair value for the land I'm building is 970. This 970, that's the 560 plus the 410, 970. I remove subsequent accumulated depreciation, which is 28, that I completed above. And this gives me 942,000 as my carrying amount. And there is the figure that goes to my statement of financial position. If you had solved those questions we did last week yourself, these ones would be a piece of cake, because this one are easy compared to what we did last week. Okay, that's note 2. Now for note 3, they said on January 1st, 2020, an item of office equipment was purchased for 128 million. And again, before I go ahead, they purchased on January 2020. And I know that the year end is June 2020. So that means this was purchased during the year. So you have to be very careful because it might require provision. Okay, they purchased office equipment during the year, and a further 22 million was spent commission and installation of the equipment. Depreciation is 18.5%, 18.5%, and it is appropriately apportioned on a time basis as situation demands. So saying that depreciation is appropriately apportioned on a time basis is speaking to the fact that some of the assets were acquired during the year. That means the depreciation must be prorated, meaning that there are some questions that will tell you that even if the asset is acquired during the year, charge full year depreciation, meaning you won't prorate. So this one are specified, so you prorate. If they are silent, you prorate. If they are silent, it's better to prorate. So they said there was no disposal or acquisition. Okay, fine. So let's quickly account for this. And that's the last one, office equipment. So let me get the total cost since they acquired some of the assets during the year. So at the beginning was 525 million, which is this. This one they gave me here, 525 million. Then we have some additional assets, which is 128 plus 22. The 128 plus the 22 million. Then that makes it 150. If I add the two together, it gives me 675. That's my total cost. And this is that 128 and 22. They are to be capitalized. 128 and 22. This installation cost too should be capitalized. I removed my accumulated depreciation. At the beginning, my accumulated depreciation was 334 million from here. See, 334 million in the notes. Then, since I know at the beginning, then for the year, ordinarily, if not that they bought some of this asset during the year, ordinarily I should just have done 18.5% on this cost at the end. But since this 150 addition was bought during the year, I have to prorate that portion. So I need to calculate depreciation separately for the cost at the beginning and the one bought during the year. So for the beginning, I just applied the 18.5% on the 525 for the whole year. The one that was bought during the year, I do 18.5, okay, multiply by 6 over 12. Multiply by 6 over 12. By the time I add the two together, I get 111,000. So by the time I remove that, by the time I add the two together, this 334 plus 111,000, my accumulated depreciation is 445. So my cost of 675,000 minus my accumulated depreciation of 445 gives me carrying amount of 230,000. And that is it for this question. So all I just need to do now is to prepare my statements. So easily meets the financial position as at the year ended. My field premises, the carrying amount for 2020 is 942,000. The comparative figure at the beginning, and you know where I got this 942, my workings here. The workings I did up here for the carrying amount. The opening figure, because the question asks us to do comparative figures, meaning the immediately preceding figure. So for the field, this is my 895. So all the figures here is what I'm using as opening. So I won't have to come back here. So 895. For the office equipment, this is 230, which is this 230 here, plus the opening in the fixed asset schedule up there. Then the computer software, the fair value of 333, and the opening value of 990 here. Is 990 here. And that's my statement of financial position, both for the year and comparative figures. Okay, and that would be my opening balance, and that would be for the 9 marks, and that's that. Okay, so we are done for intangible assets. I'm going to stop here for today. So before now, my plan is that after this question, I'm supposed to solve more questions on published. I have a lot of questions here for you guys that we're going to be dealing with. But this one requires that we know some other standards. So I'm going to take the pen next week. I I think I will teach you intangible IFRS 16. Is it IFRS 16? I'll teach you financial instrument next week. Then I hope to start and finish it that next week. When I'm done, then we'll go to 16. Then we go to IAS 6. Then I would quickly run through, not quickly. We'll take our time to run through those standards. Then I'll now come back and solve almost 10 or a lot of published account questions, because that is your question one. Not only question one, you'll find it in a lot of areas in your exam. And when I'm done with solving a lot of questions unpublished, then we can then go to ratio analysis, which is interpretation. Then we'll move to, I'll teach you about blockchain technology. Then finally, we'll teach you ethics. Then we'll do revisions. Then we'll be done with the diets. We'll just prepare you for your, just left for you to go and pass your exams. So do I have any question? If you don't have questions, then let's call it a day for today. Any question? All right, if there are no questions, so thank you very much. See you next week, Saturday. Bye-bye.
Thank you, sir.
You're welcome.